What if I told you that losing money in the stock market could absolutely be one of the best moves that you can take advantage of this year? Could actually make you wealthier in the long run. Look, all those red numbers that you hate to see could be the key to unlocking thousands in tax savings. Look, it sounds crazy, I get it, but here's the deal. Most investors, they panic when their portfolio takes a hit. They sell everything, they get nervous, they get anxious, and they walk away discouraged. Sometimes they run away discouraged. Meanwhile, wealthy, committed, disciplined investors, they see the opportunity. They aren't afraid. And it's because they know how to use their losses strategically to benefit their overall estate. They win regardless. They use those very same losses as a powerful tax savings weapon, a strategy known as tax loss harvesting. They can reduce their tax bill, reinvest smarter, and protect long-term gains. It's one of the most unutilized tools available. And today, I'm going to show you how it works, when to use it, and the biggest mistakes to avoid, and how it can fit seamlessly into your wealth building plan. I'm Andrew Nida. For over 15 years, I've helped families, business owners, and high net worth individuals reduce their tax bill using incredible available strategies, helping them play the game. Sometimes they're saving 20, 40, 50, sometimes 200, 300,000 in their tax liability this year, just because they're exploring and just because we're making the right decision ahead of time to put themselves in a position to win the game that you're playing regardless. Let's get to it. Let's jump right in. Let's take some time to understand capital gains tax. Let's start with the basics, because before you can save on taxes, you need to understand what kind of tax you're actually trying to save from. We need to understand basically what we're up against. Look, it's one of the biggest hidden expenses investors face. They enjoy the gains, but they're not thinking about what the government's going to come when they actually realize the activity. When you sell an investment, doesn't matter if it's a stock, a mutual fund, crypto, you're going to trigger a gain or a loss. And a gain, which is a profit, is taxable. I'll give you a quick example. Let's say you buy a stock for $1,000. A year later, it's worth $1,500. You sell it. It's a $500 profit, and it's a capital gain. And Uncle Sam, well, he wants his piece. Did nothing for it, didn't take the risk to get it and to make it, but you got to pay him. Now, the timing of when you sell, that makes a big difference. There is short-term and long-term capital gains. If you sell that same investment within 1 year, that's a short-term capital gain. Look, it's taxed like a regular income, which it could be as high as 37%, not including net investment income tax. Let me give you a quick example. If you're an individual income earner, you make $200,000 a year, you're at a 32% federal tax bracket. You buy and sell a stock within 3 months. You make $10,000, you're going to owe the government $3,200, like that. However, if you hold the stock for more than a year, then it's going to become a long-term capital gain, and as a result, the tax rate drops dramatically, goes down to potentially 15%, for some people 0. Now, that same gain held longer. What that did is it just dropped that tax liability to maybe $1,500. That's a $2,200 savings just by holding the position a little bit longer. The truth is, timing matters. The longer you hold, the less you'll pay. But what if the stock drops? What if you're trying to take advantage of the start of a nasty year? You like the stock, but it's not doing well. Then what? So what is tax loss harvesting? Look, tax loss harvesting lets you use losing investments to your advantage. Here's the core idea. When an investment goes down in value and stays down, you can sell it, realize that loss, and use it to cancel out gains elsewhere in your portfolio. Let's break it down a little bit and give you a real-world example. Let's say we have Sarah here. She made $10,000 in profit by selling a stock earlier this year. She's holding another stock in her portfolio that's down $9,000 from her original purchase. If she does nothing, she pays taxes on the full $10,000 in gain in stock A that she sold. If Sarah does sell stock B, she wipes out the taxable gain from stock A. She now only owes on $1,000 of net gain. It gets even better. One of the most powerful features of tax loss harvesting, the most overlooked tools that advisors discuss and talk about, is the ability to carry forward losses, even for a standard deduction or for offsetting large gains. Let's say you had a bad year in the market. You go and harvest $20,000 in losses or book $20,000 in losses, and you only have a $5,000 gain that year. You can apply $5,000 to cancel out that gain from all your losses. But here's where it gets interesting. You still have $15,000 in losses that you put on the books. that's remaining. What happens to that? Well, it doesn't disappear, doesn't expire. It becomes a tax asset you carry forward into future years. Even in a year where you have no gains at all, the IRS allows you to put some of those losses to work. It's not much, but you're still gonna use it. You get to enter the $3,000 deduction. Each year, the IRS allows you to deduct that amount off your ordinary income, like your salary, your W-2, your little side hustle, your rental profit, money you earned at work, whatever. That means if you're in a 24% tax bracket, many people are, that $3,000 deduction could save you $720 in taxes. Look, it's automatic year after year after year. That's a simple way of using it. Think of it this way. It's like having a backup plan for a bad investment. If you didn't make a single dime in gains this year, you chose to harvest losses, book those losses, and reduce your taxable income, getting money back from the government. Let's say in 2023, you harvested $40,000 in losses. That same year, you had a $5,000 gain, which were fully offset. You deducted $3,000 from your regular income. Now in 2024, you have no gains at all, but you still deduct another $3,000 from your income. And the rest, it's still waiting in the wings to offset your future profits. There's no expiration date on carry forward losses. So even if the market booms next year, you make big gains, you're still offsetting those taxes with last year's losses. So when should you use this strategy? How do you actually use it wisely? Because here's the truth, not every loss is worth harvesting. Timing matters, strategy matters, intent matters. I'm gonna walk you through how to approach this like a pro. All right, step one, identify harvestable losses, okay? Start by looking at your taxable brokerage account, not your retirement accounts, all right? No IRAs, no 401ks, no Roth IRAs. Those don't qualify for tax loss harvesting. They're tax advantage accounts. You hadn't paid taxes on them or you already have. Now, within your taxable account, you gotta ask yourself, which investments are down? It's pretty simple, probably in red. Do I still believe in the company? Or do I believe in this fund long-term? Would I buy this again today? If the answer is no, that's a candidate for harvesting. Now this is if you're doing it yourself. There's some other options if you're one of us and do it for a living. Step two, I'm gonna give you an example when not to harvest. Just because something is in the red doesn't mean it should be sold. Ask yourself, is this just a temporary dip in a strong company? Am I emotionally reacting or strategically rebalancing? For example, you own Apple and it drops 8% this quarter alone, but you believe in it for the next decade. You may not want to sell just to save a few bucks on taxes, unless you're going to strategically sell and consider repurchasing at some point in time. Don't let the tax tail wag the investment dog. Good investing is more important. Now, tax strategies should support, not override, your investment philosophy. So you need to be mindful before you just start selling losses. There's some rules and laws behind washing a sell, which I'll talk about in a little bit. Now, step three, timing is key. Most people only think about tax loss harvesting in December. It's dumb, okay? Smart investors, smart advisors look at their portfolio quarterly or even monthly in volatile markets. You don't need to wait for a massive crash. Even modest losses can add up over time, especially if you're rebalancing anyway. Look, if you hold a lot of individual equity in your portfolio and it's built in a way to support harvesting, you should do it frequently. Think of it like pruning a tree. You don't wait until it's falling over and then say, probably should prune the tree, shape it up so it's gonna grow, hopefully stronger. No. You do it consistently, patiently, over time. You kind of set a reoccurring calendar once a quarter if you have to, if you're gonna do it yourself. Spend 20 minutes at that point to take a look at it. It's a tiny investment of time that can go a long way if you're doing it yourself. If you have a professional, well, it should be considered at any moment, at any time the markets are open. Step four, reinvest strategically. This is the part most people overlook. Let's say you sell a stock at a loss. Now what? You want to keep your portfolio fully invested. So you reinvest that money into something similar, but not identical to what you sold. Here's why. Because if the market rebounds during those 30 days, you want to capture the growth without triggering the wash sell rule. The IRS says, look, if you sell a security at a loss and then basically buy and repurchase that same or substantially identical security within 30 days, the loss is disqualified. You miss this step, you lose the tax benefit entirely. So you got to be somewhat strategic. You got to be mindful in how you're going to reinvest and engage that money back to work in your portfolio. Step 5, track your harvest. The IRS is not going to do this for you. Why would they? Look, here's where the rubber meets the road. Your harvested losses, right? You got some? Now what do? Well, you want to make sure they're properly recorded and reported. Your custodian or financial institution will typically issue a 1099-B showing the realized losses. Use tax software or work with a CPA to make sure those losses are properly applied to your return, to things like your capital gains, your ordinary income, up to $3,000 once again per year, your carry forward or future years. You need to make sure it's organized, clear, and you understand how to use it. Keep a simple spreadsheet if you need to for your harvested losses, and that way you have an idea of what is remaining year over year, so you never forget. Or work with Asset Management Group, a firm that's gonna keep it up for you. Now, tax loss harvesting is one of those rare strategies that lets you turn pain into power. Literally, you don't feel good about the market going down, but there's ways to win. You're using your losses not as a symbol of failure, but as a tool of long-term growth and tax efficiency. You use this thing consistently. Tax loss harvesting becomes a silent multiplier in your wealth chart. You're gonna reduce tax drag. You're gonna reinvest tax savings. You're gonna stay fully invested, and you're gonna reduce your portfolio churn. So many good benefits. Harvesting $5,000 a year and reinvesting those tax savings could lead literally to $200,000 plus in over 25 years at 7% growth. That's $5,000 a year. Imagine what our wealthier clients have the ability to do. That's money that's compounding, not leaking to the IRS. It makes a huge difference. And more importantly, it makes a difference in your state, not the government's. Let's recap just for a second. It's hard, it's a complex topic, but it's one you gotta grasp, okay? Or you gotta hire someone that gets it. You can't miss one of these pieces. You gotta apply it consistently, and you gotta make sure you do it on the up and up, and you're making the right decisions. Tax loss harvesting, it can turn pain into power. Look, when the market hands you a red day, don't panic. You might need to pivot. You might need to take advantage of it. It's an opportunity. You should take the loss and make it work for you. It's not just for big investors either. Whether you're investing $5,000, $500,000, $5 million, harvesting losses can reduce your taxes, optimize your investments, and smooth out the emotional roller coaster of investing. The $3,000 deduction, it helps, even in years with no gains. Harvesting losses can lower your ordinary income. It's a subtle wealth building tool year over year that compounds and creates a significant impact in your wealth. The carry forward rule is a long-term gift. Losses you harvest now, they don't disappear. They're gonna stay with you like a personal tax shield, ready to reduce your future gains year after year. You're booking those losses, you have them ready, and you know when to execute. Strategy beats reaction. This isn't about panic selling. It's about being intentional, disciplined, and smart with your money, especially in volatile markets. It's moments like these, rubber meets the road, and if you know what you're doing, you're gonna win. Have you used tax loss harvesting before? Have you ever heard of it? If this is your first time, let us know. If you've used it, give us an example of your success. Set a reminder today to review your portfolio before year's end. Do it quarterly. Even a small harvest per quarter can pay big dividends over time. Look, if this video gave you clarity or confidence, please tap the like button. It helps more people discover this strategy. And make sure to subscribe so you never miss wealth building tactics just like this and great tax guidance for individuals just like you. Thanks for watching. I'm Andrew Nida. You've got the tools, now go use them. And if you need us, give us a shout.